Hey guys, I just wanted to take a couple minutes today and show you why I believe Salesforce, ticker CRM, is an undervalued stock and a buy in today's market. So just to kind of put in perspective and look at the all-time chart here, from inception to current, the price now is at 242.76. You can see the price, has hit above 300 before, but most notably, what I'll probably dive it into throughout the slideshow is that, you know, you can follow the trend here, and although it's been up over time, it's been pretty flat here over the past 5 years or so. And I mean, unless you bought at the bottom. And it's interesting to see because, yes, the revenue top line has gone down to single digit growth, but the free cash flow and the size of the business, I believe, is a tremendous buying opportunity at the moment. So it's also interesting to get an understanding of what the insiders of the company are doing and if they're buying. And you can see here and as well in the next slide that the director David B. Kirk, I'll pull out my highlighter here, picked up 865, almost $866,000 worth of shares, with this being his first insider purchase since April. Yeah, so sorry for the quality about this picture. I thought it'd be a little better, but I still wanted to keep it just to kind of illustrate the point that there's only been two ever instances where, insider purchases has ticked up. One, let me pull out the laser here. One time here in 2018, and then 2014, you see a little kick up, and it being dead for the most of the time here. 2014 kick up and a 2015 kick up. If you look back at their company chart from 2018, you can see this stock moves straight up after a lot of these insider purchases, and I'm willing to bet because it's so undervalued now, 24 and 25, there's probably room for a nice gain here too. So I included this slide kind of just to show that, Salesforce is back here in M&A mode, inquiring Informatica, I'm probably mispronouncing that, for $8 billion here. It's a massive bet Salesforce is putting down for their AI and data cloud segments as, the traditional revenue starts to flatten out and stagnate. So I'm not gonna run through each individual fundamental trend here, but there's eight here that you can see, or I guess seven. I'm kind of, my face is blocking the bottom right here, but you can just see the overall trend in every category progressing to the right. You can pause the video if you want and just check it out. If you remember from the beginning slides, the price has been pretty flat over the past several years here. I wanted to attach this chart here to just kind of show this is the free cash flow per share quarterly from 2015 through Q3 2025. And with Salesforce's share price basically flat, August 2020, 254, I believe it was at, with September 2025 being at 252. Yet in that same amount of time, the free cash flow per share, as you can see in the table, has surged from 389 to $13.11. If the price eventually tracks free cash flow per share, that could make Salesforce, a really good buying opportunity right now. Well, with all the good comes some bad. So I just wanted to point out, some things that definitely haven't been working out, or, something an investor may not necessarily like to see. Here's their revenue growth by year here, going from 2012 all the way to 2025, with an expectation here for 2026. You can see it teetering off, from 35, and I think this is the big reason for the multiple compression, is that 25 and 26 here, we've now reached sub 10% growth, and investors do not like to see that. Here's an interesting title, talking about what we just spoke to, revenue hitting that single digits and may be attributing to that multiple compression. The Salesforce CEO said his goals to bring sales growth back to double digits as revenue, nears 50 billion a year, citing early acceleration in AI-driven demand. Current growth is about 9%, and the CEO said the industry, in his opinion, is entering a major AI investment cycle. So here's the summarized DCF. Here's their actual performance here again in millions. So this is 37 billion in revenue, 32, almost 33% free cash flow, which is phenomenal. Um, and that comes out to about 12.5 billion in free cash flow. I'm growing here revenue at the analyst consensus of 9% for 2025 and 2026. And they've had their recent M&A deal, which we talked about, and that their management guidance was that they're trying to get it back up to 10%. Let's say they don't even hit 10% and just go 9% for 3 more years. Never hit the double digit growth again. And then we hit terminal, then they never grow much beyond 60 billion in size of revenue, and they're just growing at 3% growth here. Again, going down the assumptions for free cash flow, about 33% free cash flow, change in 33.4 at the analyst consensus, the 34 consensus, and then basically going at where management thinks they can guide it to at 35%, which is again a phenomenal number on free cash flow. Software companies, typically see that high free cash flow. And then basically, we're gonna take the free cash flow numbers and divide them by the mid-year convention with a discount rate of 9%. I think 9% fits. I think it could even be towards 8 a little bit. But with these more conservative assumptions we're taking, but the 9% growth rate would be 1 divided by 1 plus 0.9% raised to the zero point 0.5 and then plus 1 for each year after that to account that a company's getting its cash flows evenly throughout the year. If you assume too early, then you're going to have, too high of a value. If you assume too late, you're going to have too low of a value because a dollar today is worth more than a dollar tomorrow. Yada yada. You times the free cash flow by our mid-year convention. Ours is basically a present value function, and we get 13 billion, and it rises all the way up. And why the terminal year? The terminal year captures perpetuity, right? So 25 to 2029 is 5 years, and where is it going every year after that? That's why the bulk of this value is coming from the 350, where the other free cash flows are so little. The terminal period carries majority of the value. So the sum of the free cash flows here I'm getting is 305 billion. They have 15 billion in cash, which they can use to pay down their 11 billion in debt. So they actually have 4 billion here of a net downward because they could use cash to pay off the debt. So their enterprise value actually goes down from 305 to 302. Usually you see more debt and less cash, and this number going up instead of down, but whichever, it doesn't matter. Um, and the shares here around it are 952 million, and that gives us a target share price of $317 versus the current price of $241, which for a margin of safety with the very conservative assumptions at 32% for a company, $38 billion in size, I think provides really good buying opportunity, especially considering we're seeing insider buying for the first time in a couple of years. That's all I had to say. Take care, guys.